Many executives stop contributing to their 401k when they hit the pre-tax contribution limit. You didn't. You made after-tax contributions. Smart move. But the step you didn't take next may be quietly turning that move into a compounding tax liability you had no reason to expect. This video is not about future 401k contributions. Watch my video on 401k critical mistake number 1 for that. This video is about the after-tax contributions you've already made, sitting inside your 401k, unconverted, and silently generating earnings that could be fully taxable when distributed. That tax exposure could reach tens of thousands of dollars. That's 401k critical mistake number 2, and many executives won't discover the cost until years of tax-free growth are already gone. Hi, I'm David Dunn, a CPA, wealth, and tax strategist, and the founder of David Dunn Wealth. For over 30 years, I've helped technology and aerospace executives grow and protect their wealth, from optimizing their 401k and RSUs to managing executive compensation and tax strategy. Those 30 years showed me the same pattern. Sophisticated executives making costly mistakes, many beyond fixing by the time I got involved. That's why I created the Critical Mistakes series, my signature educational platform designed to help executives avoid critical mistakes, some costly, others irreversible. This mistake lives in the gap between what you did and what you didn't know to do. You made after-tax contributions to your 401k, but you haven't yet rolled them over to a Roth IRA. Skipping this step could cost you tens or hundreds of thousands in avoidable taxes, money that could have been growing tax-free. Unconverted 401k after-tax contributions can easily turn into a six-figure tax exposure. Here's why. Your 401k has 2 contribution limits. Many executives only know about one of these limits. These are the IRS 401k pre-tax contribution limits for 2026. $24,500 if you're under 50. $32,500 if you're 50 to 59 or 64 or older. That's the $24,500 base plus an $8,000 catch-up contribution. $35,750 if you're 60 through 63. That's the $24,500 base plus an $11,250 catch-up contribution. New for 2026, if your individual compensation exceeded $150,000 in 2025, those catch-up contributions must be made as Roth contributions. But the IRS sets a second limit, one far higher than the pre-tax limit. For 2026, the total 401k contribution limit, which includes pre-tax, after-tax, and employer contributions, is $72,000 if you're under 50, $80,000 if you're 50 to 59 or 64 or older, $83,250 if you're 60 through 63. That means, depending on your employer's contribution, you could contribute up to $47,500 in after-tax contributions. And when those 401k after-tax contributions are rolled into a new Roth IRA, the growth could be tax-free when distributed. That changes everything. Maxing those limits is where the real opportunity begins. Many plans allow for additional 401k after-tax contributions once you reach the pre-tax limit. Contributions that open the door to powerful Roth rollover strategies, but only if handled correctly. Let's put a number on it. Meet Maya, a 60-year-old senior executive at a leading tech firm. Over the years, Maya contributed $100,000 in 401k after-tax contributions, but she never rolled them over to a Roth IRA. Over time, those dollars generated $200,000 in earnings. The $100,000 contributions, she can withdraw that tax-free. But the $200,000 in growth, fully taxable as ordinary income when distributed. If Maya is in the 37% tax bracket, that's a $74,000 tax bill. And that bill can grow larger every year. Those after-tax contributions stay inside the 401k. The longer those 401k after-tax contributions remain unconverted, the more earnings accumulate, which just makes the tax exposure worse. Here's how to stop it. Step 1. Open a new Roth IRA and a new traditional IRA with the brokerage firm of your choice. Step 2. Call your 401k provider. Have them roll over your after-tax contributions to your new Roth IRA. Next, have them roll over the earnings on the after-tax contributions to your new traditional IRA. Done correctly, this avoids the 20% mandatory withholding. Step 3. Work with an advisor who has command of the IRS rules governing these rollovers. One misstep could trigger a tax bill you weren't expecting. 2 warnings stand between this strategy and a costly mistake. Warning 1. Create a new Roth IRA and a new traditional IRA for these rollovers. Do not use existing IRAs. By using new IRAs for these rollovers, you can preserve the strong creditor protection that comes with 401k assets. That protection can be lost if the rollover funds are commingled with existing IRA balances. I'll cover this in an upcoming video in the Critical Mistakes series. It's too important to overlook. Warning 2. This move might affect your ability to use another strategy called net unrealized appreciation, or NUA, if you hold company stock in your 401k. I cover net unrealized appreciation in 401k critical mistake number 3, 401k critical mistake number 4, 401k critical mistake number 5, and 401k critical mistake number 6. Be sure to watch those videos before making any decisions about your rollover. You did what few executives do. You made 401k after-tax contributions. What you do next determines whether those dollars work for you or against you. If rolling your 401k after-tax contributions to a new Roth IRA fits your situation, it may be the most important financial move you haven't yet made. Let's explore working together. Schedule a complimentary 30-minute consultation at daviddunn.com. You can also subscribe to my complimentary email newsletter for insights from the Critical Mistakes series. And follow me on LinkedIn, YouTube, and Instagram. If this video saved you from a costly mistake, please like it and subscribe. It helps more executives find the series. And forward this to a colleague who takes their 401k seriously. It could save them tens or hundreds of thousands. If you haven't yet watched 401k Critical Mistake number 1, watch it next. It shows you how to hyperfund your 401k with after-tax contributions and how to convert them so that this tax problem never starts. Keep watching the Critical Mistakes series. Each one is critical.